Good morning, everyone. Last week, I was at Bharat Mandapam with our entire Dalmia leadership team, and I was brimming with pride to be standing in that iconic structure, which probably is one of the finest in the world. I can confidently say to all of you that India around us is changing. And you will agree that our government has played a defining role to shape a development agenda and ensure that we soon become the world's third largest economy by 27-28. Our country has undergone a huge metamorphosis with a lot of reforms in the last decade. Steps, whether in form of banking reforms, GST, IBC, or direct benefit transfer, have given a rock-solid foundation to India and the much-desired immunity from adverse global economic events. And the beauty is that the impact of most of these reforms is irreversible in nature. All these reforms have placed India on the world map and attracted substantial international investors and investments. The base for sustainable growth has been set. The momentum is clearly built, and we are now transitioning from a reform phase to a fast growth phase. The world looks up to India not only for its political significance, but also for the large economic benefits where India can make a significant contribution to world growth. With growth slowing down the world over, India's demographic dividend will help us shine for not only this decade, but many, many decades to come. The government's continuous thrust on infrastructure has led to the turnaround in the real estate sector, and the private capex has started to kick in. Recently, there are some reports that the government may taper the infrastructure budget allocations to control fiscal deficit. However, I personally believe that infra development and job creation will remain two key focus areas for the next 7 to 8 years. And foreseeing this massive growth opportunity, we remain committed to our plan of 110 to 130 million tons by 2031. With general elections around the corner, there could be some temporary cyclicality, but the long term looks very, very promising. Cement as a sector will be direct beneficiary of the India growth story, and cement demand should continue to grow higher than the GDP growth rate. Within the sector, the barriers to entry have gone up, and economy of scale is beginning to play a big role. Large companies with robust supply chains and strong brand presence will continue to gain market share, and the pace of consolidation will increase further. We were the first ones to reinitiate the conversation around consolidation. And if you look at the last 10 years, the demand share of top 4 companies has increased from about 46% in financial year 13 to almost 57% in financial year 23. Going forward, with large capacity announcements by the top 4 companies, the pace of consolidation could be much faster. This is indeed one of the best times for our sector, and increasing consolidation will potentially lead to a more stable pricing scenario in the sector. While the pricing could be volatile for a few quarters, I believe prices will grow 1.5% to 2% CAGR on an average over the long term, as we have seen over the last 2 decades. As a company, growth for me is not simply adding capacity, but also building an organization which rests on the 4 pillars of scalability, sustainability, predictability, and consistency. As I look forward, my emphasis will be on building deep organizational capabilities to deliver on each of these 4 pillars. As I was mentioning, We continue to work firmly on our vision of building a pan-India pure-play cement company of 110 to 130 million tons by 2031, with an interim milestone of 75 million tons by financial year 27. While we would take an additional quarter to announce the details of this 75 million ton plan, we are on track to deliver our first milestone of 49 million tons by March 24. We will complete 46.6 million tons by March, and we are working on closing the proposed JP acquisition within this quarter. While Dharmender will elaborate on our financial performance, I wanted to share certain highlights. I am pleased to share that we have grown faster in our core markets after 2 quarters of subdued performance. We will build further on this momentum. We continue to learn, expand our reach, and invest time and money to deepen the relationship with our distributors and our institutional customers. While this is a continuous journey, this gives me the confidence that next year we should grow in line with our aspiration and deliver a mid-teens volume growth. During quarter 3, we achieved the 8.1% YOY volume growth and delivered a volume of 6.8 million tons. Our revenues also improved in line with the volume growth. There was a marginal price improvement in both East and South, which led to a 4% price increase sequentially. However, during the quarter end, we have noticed some weakness in the prices, and the exit prices are closer to the September quarter exit prices. On the cost side, stabilization of commodity prices has given some headway in margin recovery. From almost a 27.5% EBITDA margin in Q1 of financial year 22, we hit a low of 12.8% in Q2 of financial year 23. And we are now back to 21.5% in Q3 of FY24. It has been a very volatile journey over the last 2.5 years, but that has made us more cautious about identifying and investing in levers of long-term cost sustainability and predictability. The average fuel purchase price hovered around $115 to $125 per ton during the quarter, with spot also at about similar levels. The EBITDA per ton was 1138 rupees per ton in Q3 of FY24, which has risen from the low of 656 rupees per ton in Q2 of FY23. Next year, we believe that the EBITDA per ton for the sector could be in the range of 1100 to 1200 rupees per ton, unless there is some unforeseen eventuality. I would now like to hand over the call to Dharmender for an update on the financial performance. We will answer your questions as Dharmender will open the floor for Q&A after that. Thank you, Puneet.
Good morning, everyone. Let me take you through the details of our financial numbers. During the quarter, our sales numbers increased 8% YOY to 6.8 million tons, and during 9 months by 9% YOY to 20 million tons. This includes JP plant's volume of about 0.4 million tons in Q3 and 0.9 million tons in 9 months FY24. Our revenues during the quarter increased by 7.3% YOY to rupees 3,600 crores, and in 9 months by 7.7% YOY to rupees 10,373 crores. The trade sales during the quarter improved to 63% from 60% in the same quarter last year. On the low carbon cement, we remain committed to enhance our resource efficiency and reduce our carbon footprint further. During the quarter, our blended cement was 84%, which is marginally lower than the previous quarter, but we are working to increase it in line with our long-term commitment to become 100% low carbon cement producer over the next 3 years. On the cost side, we continue to be one of the lowest cement cost producers. Our total cost during the quarter declined to rupees 4,147 per ton. Breaking into each head, our raw material cost remained flattish at rupees 781 per ton of cement production. However, since this line item also includes purchase of stock in trade goods under tolling, the increase in the financials appears much higher at rupees 939 per ton. Power and fuel cost declined 23% YOY to rupees 1,102 per ton of cement production, mainly due to the $53 per ton decline in the fuel consumption cost on a YOY basis. With this, our blended fuel cost during the quarter stands at about rupees 1.50 per million kcal. As Sunitji mentioned, fuel costs have now largely stabilized. We may only expect marginal reduction of around 3% in fuel consumption costs in Q4 FY24. Our renewable power consumption marginally dipped to 25% from 29% in the last quarter due to an unplanned stoppage at WHRS facility at one of our plants. However, it has been resumed since then. We expect our RE percentage to now be back to the normal levels in Q4. The freight cost declined by 2% YOY to rupees 1,091 per ton, with reduction in lead distance to 283 km YOY. On the fixed cost side, employee costs have increased by rupees 28 crores to rupees 221 crores, primarily due to annual increments and increase in number of headcounts due to addition of new capacities at different locations. Other expenses have also increased by rupees 27 crores on a YOY basis, mainly due to higher shutdowns with addition of capacities in this quarter compared to the last year's same period. Overall, our EBITDA during the quarter improved by 11% YOY to rupees 1,138 per ton, which is the highest in the last 9 quarters. Regarding incentives, we have accrued rupees 69 crores of incentive during the quarter. The collection during the quarter has been rupees 153 crores. For 9-month period, the total accrual stands at rupees 217 crores and collections at rupees 216 crores, almost similar. The average receivable as on 31st December stands at rupees 718 crores. For FY24, we expect the total incentive accruals to be around rupees 280 to 300 crores. Moving on the balance sheet items, depreciation during the quarter has increased by rupees 45 crores on a YOY basis. Of this total increase, rupees 9 crore pertains to certain components of plant and equipment which are being replaced as part of our overall debottlenecking projects. This was a one-off charge which we had shared with you earlier in our calls. Coming on to the expansions, our cement debottlenecking project of 0.9 million ton in Belgaum has been commissioned during the quarter. Our expansions at Kadapa and Arelur for 1 million ton each are also progressing well and will be completed by March 24. With these expansions, our cement capacity in South will reach 17 million ton and total capacity of 46.6 million tons by end of this fiscal. This excludes 9.4 million tons capacity coming from JP. Regarding our other expansions beyond FY24, we have ongoing work for 0.5 million tons in Kalyanpur and 2.4 million tons in Lanka, Northeast, which are expected to be commissioned in second half of FY25. Capital expenditure spent during 9 months of the current year was rupees 2,142 crores. Our total capex spent during the year FY24, excluding the JP plants, is estimated around rupees 2,000 crores. This includes expansion projects in Northeast and Bihar. The cash outflow for JP plants is expected around rupees 3,300 crores whenever it gets consummated in next few months. During the quarter, we have received the final tranche of rupees 120 crores from the divestment of Eco-Store business to promoters. With respect to refractory assets, we had already received 160 crores in April this year. The next installment of 320 crores is also received during the current quarter. The balance 320 crores will be received in September 24. Since we had a cash inflow of 440 crores, we have repaid some of our short-term debts during the quarter. The closing gross debt now stands at 4,928 crores. Our treasury balance has also increased by 704 crores, primarily with the MTM gain booked for our holding in IEX by rupees 476 crores. As a result, the net debt of the company has decreased by rupees 1,069 crores to rupees 431 crores in this quarter. Net debt to EBITDA multiple materially improved to 0.16 times as on 31st December. We believe that even after the acquisition of JP Plants, our net debt to EBITDA will remain comfortably below our target of 2 times. With this, now I open the floor for question and answer. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Amit Murarka from Axis Capital. Please go ahead.
Yeah, hi. Good morning. Thanks for the opportunity. So, the first question is around the capacity utilization and your expansion plan. So, like based on current volume, you seem to be at 60% utilization with expanding capacity, and I believe we are still sticking to
sorry to interrupt you. Can you please speak a little louder?
Yeah, hi, sorry. Yeah, I hope this is better.
Thank you.
So I was asking that the capacity utilization seems to be like under 60%, and the expansions are quite steep from here, and there's expectation of 75 million ton as well by FY27. So, what's the plan like to take the utilizations up? Like because the implied volume growth will actually be upwards of 15% if the current expansion plan needs to come through.
So Amit, Rajiv here. Amit, as Puneet said in his opening remark, we had slightly softness in our volume growth in the first 2 quarters, but now with a lot of initiatives that have been taken during the quarter, we have seen good growth this quarter. And building on the momentum, I think we feel pretty confident that we'll be able to deliver a mid-teens growth in volumes next year. And that is in line with our long-term thinking in terms of, the volume growth should be in mid-teens. So, there would be always, when you look at it, 7-10-year plans of expansions and the India story and how the sector will play out. I think it's important to keep this this goal in place and probably tweak a little bit here and there as we go along, right? So we had put an intermediate milestone of 25 million tons by FY27, and we also have put a guardrail of 2 times net debt to EBITDA for ourselves. And given that we saw a slight weakness in the volumes, we have delayed by a quarter. So we are back to the drawing board. We are looking at, how we are seeing the next 2 years initiatives playing out. But, having said that, I think our long-term story is intact. We continue to believe in the sector, in the momentum that has been created, the beneficiaries of the sector, of all the India growth and infrastructure growth is going to be cement. So long-term vision and strategy remains intact. There could be a few tweaks here and there as we go along. So, but I believe that mid-teens growth for the top players is going to happen.
Got it. But I just wanted to understand like that in this whole process when you go about capacity mapping, like what comes first? Like is a capacity goal coming first, or is it like the current volume and market share that you're carrying is based on which you'll derive the capacity expansion plans? Like how are you going about it?
So it's a mixture of both. See, so far the first milestone of 49 million ton was mostly in our existing locations, right? So there we are seeing we want to gain on the market share. There's competition happening, the competition expansion plan. So we wanted to, increase our footprint there and also ensure that we have a good market share there. The next set of growth is going to come in new regions. As Puneet also said that, we have a pan-India vision. So as we look at expanding in newer regions, any volume that we get is going to be incremental for us. So, from that extent, I think it's a mixture of both. We believe in the India story. We believe in a 15% CAGR volume, the capacity growth. We want to be 110 to 130 million ton player by 2031. At the same time, we are taking a lot of initiatives. Puneet was referring about, how dealer networks are being built, how the dealer initiatives are being done, how we are looking at a branding and everything. So we believe that volume will catch up. Last year we grew at 16% volume. Revenue growth was 20% in line with what we had guided for. And this year the volumes are slightly lower and the revenues, but next year we should catch up. So I think there could always be blips in this journey because it's very difficult to predict quarter on quarter, year market by market. But I think we are not seeing anything in our macro scenario in our market that makes us believe that this is not good.
Right. And lastly, what will be the interplay between volume and pricing when you go about that 15% plus volume growth expectation?
See, as Puneet was also saying, when you looked at the data for the last 10 years, 20 years, see, prices are always volatile quarter on quarter, right? There's seasonality, there's a geo mix, and there's a competition mix and new capacity coming out. There are many, many factors which impact the prices for the quarter. But if I look at the long-term 10 to 15-year pricing, it has always gone up between 1.5 to 2%. Some years goes up by 3.5%, some years goes up by 0.6%, but on an average 1.5-2% pricing is we get. So I think when we are modeling for the future for the next 7-8 years, we are factoring in about 1.5 to 2% price increase, right? So I think the pricing and volume, I think we are assuming it's 1.5-2% price increase, and then we are assuming a mid-teens volume growth, which we need to deliver. And again, it may differ by region to region, but again, we want to grow at mid-teens volume for the next 7-8 years.
Sure, I'll come back in the queue. Thanks.
Thank you. I request to all the participants, please restrict to 2 questions per participant, and please join the queue again for a follow-up question. Next question is from the line of Rajesh Ravi from HDFC Securities. Please go ahead.
Yeah, hi sir. Good morning to the team. So first question pertains to what is the clinker production in Q3 and 9 months? And second, could you elaborate on the JPA deal and what was the volume from the JP in this quarter?
Ravi, Rajesh, clinker production we don't share separately, and the JP volume, as I mentioned in my opening remarks, in this quarter was about 0.4 million.
So what is the status on the deal, completion? Could you throw some, what is the progress?
Yeah, as it is linked to certain approvals by third parties, so it is taking longer than what we had expected initially. So we expect to complete this in the next couple of months only.
Okay, so this first round you're expecting to be completed by March, right?
We are trying our best, yes.
Okay, and sir, what is the thought process on business expansion in the central market? What sort of dealer network we have been able to execute so far?
That is progressing well. So that is the result that the volumes have been progressing every quarter higher, and we expect that in the coming quarter this will progress much further.
Okay, and full year any volume growth guidance which you would want to look at? 10-11% for full year, is that a reasonable number, sir?
For the next year, Puneet has already mentioned that will be around mid-teens. And current year, 3 quarter you already seen, and we are on a recovery path. So in line with the industry, they should be improving.
Okay. And some housekeeping numbers, trade, non-trade, and blended cement production share, if you could share, please.
The trade, as I mentioned, was 68% in this quarter. 63%, sorry. And the blended percentage was 84%.
And premium cement sales?
Sorry?
Premium cement in trade sales? Percentage of premium cements?
Premium is 21% this quarter.
And sir, I missed this per kcal number, fuel cost. If you could repeat that, please.
Yeah, 1.50.
1.50. Now this is almost a bottom at what you're looking at, right?
Yeah, as the prices are stabilized and marginal softening is there, so we may expect 2-3% drop in the coming quarter.
Okay. Great, sir. I'll come back. Thank you.
Thank you. Next question is from the line of Indrajit from CLSA India. Please go ahead.
Hi, thank you for the opportunity. I have a couple of questions. First, going back to your volume growth expectation of mid-teens, what kind of industry growth are you penciling in for expecting mid-teens growth for us? The reason I ask is most of the consolidation in the sector is now done. I don't see capacity is being added by the same 5-6 players, so unlikely to increase further. So what is the kind of market share gain you are penciling in?
No, so Indrajit, Rajiv here. See, you look at what we have been saying, that GDP will grow about 6.5%-7%. We expect cement sector to grow about 1.3 times GDP over the next 5-7 years, which would mean the cement sector would grow about 8.5%. If you look at the data of the last 5-7 years, as Puneet and Dharmender were saying in the opening remark, almost 100% of the incremental demand has been coming to the top 4-5 players, right? So if you factor in a cement sector growing about 8.5%, and you just put on Excel spreadsheet in terms of the whole 8.5% coming to the top 4 or 5 players, that means the top 4-5 players will grow about 13-14% year on year, right, on an average. Within that, given that we have more headroom to grow, we are getting a newer market. Our utilization is one of the lowest in the industry, as just one of you rightly pointed out. We believe that given our initiatives that we are taking into, many things that we're doing in terms of organization building, in terms of market reach, in terms of dealer networks, in terms of new market development, we believe we should grow about 15-16%. That's the reason we believe that we will grow in the mid-teens.
So mid-teen is more like a medium-term number, not like an FY25 guidance as such. Is that correct?
No. See, what we're saying is that we believe that given all the stuff we are seeing, we should grow between 15-16% year on year. That's what we've been saying for the last 2 years now. Last year we did grow 16% volume. Revenue was about 20%. This year it has been slightly subdued. We still have this quarter, and we are hopeful that this quarter will do exceedingly well, but we'll have to wait for how the numbers play out. But again, the idea is that on an average, we should go 15-16% year on year for the next 3-4 years.
Sure, that's helpful. Second question, actually coming back to this quarter, right? If I strip out JPA tolling volumes, our volume growth is close to 2-3%. Do you think it is in line with industry, or you would have lost market share again in this quarter?
I think we would have gained market share in most of our markets.
Indrajit, when you look at that 2-3% volume growth excluding JP tolling, given that we are predominantly in East and South, and East market this quarter has been very soft, we believe we have gained market share, especially in East.
And JPA tolling profitability will be significantly lower than our regular core business profitability. Is that correct?
That is true. It is too small, right? At a 400K volume, it's still in the investment phase, right? We're still developing dealer network, we're still investing in the brand, we're still trying. So, of course, anything that you do new for the first 18-24 months, it's an investment phase, and the margins will be definitely lower than the average.
Also, just to add to what Rajiv is saying, this is Puneet. We still don't have full control of the manufacturing operations, so the cost structure of these plants is also quite high. And I think to bring them to the Dalmia cost structure, it can be done only once we complete the acquisition. So we are working with a high cost, facility, but it is helping us, establish ourselves in the market ahead of the team.
Sure, no, that is understandable. One last housekeeping question. I missed the capex guidance for this year and next year.
Yeah, this year, other than JP, we expect the capex to be about 3,000 crores. The JP cash outflow, we expect around 3,300 crores. And next year guidance is around 3,000 to 3,500 crores.
This includes any incremental capex in JP, or it is just on the organic current business?
Yeah, includes JP also.
Okay. Thanks. This is helpful. That's all from my side.
Thank you. Next question is from the line of Rashi Chopra from Citigroup. Please go ahead.
Thank you. Just taking on the question on the volume growth. So you mentioned that you gain market share in the East, given the softness we saw in the Eastern market. So I understand that you're working on a strategy to kind of recover what was lost in the last 2 quarters. But you also mentioned that in the fourth quarter you're expecting to grow in line with the industry. So I mean, how do I read into this? Is this because of the elections, or how do one think of at least the fourth quarter?
So we are trying to gain market share in quarter 4 also, but just to be conservative, we said that at least it should be in line with the industry or slightly better.
Okay. I mean, in your estimates for India as a whole, what was the demand growth in the third quarter as well as in the 9 months?
Rashi, you will have better numbers than we will have here. You will talk to all the companies and all the people in the industry. So I think that's a question which I wanted to ask you when I meet you next time. But honestly, we believe that this year, whatever we believe, industry will probably grow at about 8.5%, 9% odd. It's different region by region, very difficult to put those numbers right now till we see the full, everybody announcing the numbers. But I think industry as a whole should grow about 8.5%, 9%.
Okay, thanks. On your capex, the next year's capex is about 3,000 to 3,500 crores. So what is the pending capex that is remaining until this first phase of expansion gets completed? As in until you get to 49.5 million tons, what is pending till then?
There are two expansions ongoing, which is one in the northeast and second is in Bihar, Rohtas, 0.5 million. So these two are included in this.
No, I just wanted the amount actually. So individually for each of them, what is pending?
That breakup I'll be able to share separately. Overall, the capex for these two plants was 3,750 crores. And roughly about 90%, 80 to 90% is still to be spent.
And what do you count as maintenance capex within this 3,000 to 3,500?
Yeah, maintenance capex is close to about 250 crores or so.
Okay. One last question, just on the cost side. Did you mention that costs should decline by 2-3% in the next quarter, or power and fuel should decline? I'm sorry, I didn't get that.
The fuel cost should soften by about 2-3%, and power cost also will go down as we increase our RE power percentage back to the normal level of 29-30%.
So some amount of the weakness in pricing should get offset by this cost improvement in the next quarter.
That's true.
Okay. Thank you. That's it. Thank you.
Thank you.
Thank you. Next question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Yeah, thank you, sir. Sir, the first question is, as you mentioned that in the next quarter, whenever we announce the next expansion to reach a 75 MTPA, will this include the expansion to the north so that we become a pan-India player, or that will be in the next post that?
You have to wait till we make the announcement. We won't share the...
as Puneet said in his opening remarks, we are still working on it. We are still on the drawing board. There's a final details to be finalized. But again, there are two things that we said as part of our strategy and vision. We want to be a pan-India player. We want to be a pure pan-India player. And we want to have a significant presence in every market that we operate. We don't want to spread ourselves too thin in every market just because we want to be a pan-India player. And it's not that we'll achieve a pan-India in the next 1 year or 2 years. We have a 6 year, by 2031 is when we said we'll achieve. So you have to wait and see. But, we'd like to go region by region, market by market, get significant market share in each market, and then go deeper into the country. So, we'll have to just wait and see how it goes.
Okay. And next, again, coming back to the volume growth. So when we say 15-16% volume growth, so let's assume we will be able to complete GP by March. So for next year, next FY25, how much volume one can look at from GP?
I think we don't give the regional numbers for separately. So collectively, you can expect around 15-16% growth.
Okay. And when we say the next year industry EBITDA per ton would be 1,100-1,200 odd rupees, considering 1.5-2% price increase. So in terms of for us, will it be a kind of a 10% kind of a higher profitability for us?
You can consider the same numbers, reason being that we'll be also stabilizing and ramping up the GP operations. So currently we would like to be around the same numbers.
Okay. And a couple of data points. First is CC ratio for this quarter, railroad mix for this quarter. And is there any scope in terms of further reduction in lead distance, though it has increased by 6 odd kilometer QOQ?
So CC ratio in this quarter was 1.66, and lead distances I expect may not fall much and should be around similar levels.
Okay. Railroad mix and the fuel mix for this quarter?
86% is the road and 14% is rail. and fuel mix is 54% petcoke.
54%. And coal would be how much? Hello. Sir, coal and green share for this quarter was how much?
The green power we mentioned is about 25%.
Okay. Thank you and all the best.
Thank you. Next question is from the line of Devesh Agarwal from IIFL Securities. Please go ahead.
Thank you for the opportunity, sir. Sir, firstly, could you explain the sequential increase in the freight cost that we saw in the quarter?
That is primarily due to the busy season surcharge which got levied in the third quarter, which was not there in 2 months in the previous quarter.
Okay. Because the increase that I see is 6.5% on a QOQ basis, while our rail mix is only 15%. So that additional 15%.
Yeah, marginally there's also increase in the lead distance and some increase in the L2 movements also would be there.
Okay. And secondly, sir, you did mention in your opening remarks that prices have been weak and have again fallen back to the September end exit prices. In fact, our channel check suggests prices have further declined in Jan. And with limited opportunity in terms of cost optimization for the fourth quarter, are we expecting EBITDA per ton to decline in the fourth quarter versus 3Q?
We do not expect, because shortly it will get corrected by the cost offsets, and secondly, of course, industry will be trying for correcting the prices back. So we hope that whatever drops may have happened in January should come back.
Rajiv here. It's very difficult to give you numbers for the EBITDA. That's the reason if you look at what Puneet said in his opening remarks, we expect the EBITDA per ton from here on to stay between 1100 to 1,200 rupees, right? But quarter-on-quarter, it is very volatile. On an average, we get 1.52% price increase, but if you look at on quarter-to-quarter basis, the prices are volatile. So very difficult to give a number on a quarter-to-quarter basis in this industry.
Right, sir. And sir, one final question. Our CC ratio for the quarter is at 1.66x. Incrementally, is there any targeted ratio that you have, given that we will be pouring into other regions where blended cement is not as much a proportion of the overall volume? So is there any thought process around what would be the targeted CC ratio and any plans to add more clinker compared to what we are adding on the cement side?
Again, look at these, when you ask me questions about lead distance ratio, these are leading indicators of how we would like the business to grow. But these are not the decision-making points. We have to go at a certain volume, we have to get a certain market share, we have to command a certain price, we have to look at what the demand environment is. And then we have to optimize our KPIs and all the leading indicators and see how best we can deliver to the customer what is required to be delivered, right? So it's very, again, as I said, as Dharmendra said, we aspire to have 100% blended cement, right? Today we are about 86%, right? So definitely CC ratio will improve. But if you ask me, will it happen in the next quarter? It all depends on the demand environment, region by region, the product mix which is getting sold. First objective is to ensure that we get leading volume growth, right? Industry leading volume growth. We deliver it in the least possible cost. We are customer centric. We deliver the customer what is required, the best quality product. And then we have to optimize many other things, right? So I think what you have to look at is that we plan our future, and we plan our numbers, and we plan our delivery models. We focus on these things first. And then everything else is how we try to optimize the test. It's very difficult to put those as a leading thing and then plan numbers, right?
Understood. Thank you.
Thank you. Next question is from the line of Jashandeep Singh from Nomura. Please go ahead.
Hi, sir. Thank you for the opportunity and congratulations on great set of numbers. My first question is regarding demand and the performance in both South and East region in third quarter. So how did you see the region South and East perform in the third quarter? And we saw some moderation in demand in the second half of third quarter. So have you seen any recovery in both the regions in the first 25 days of January? My first question is this.
So this is Puneet here. I think on the price side, as I told you, we see more weakness only in January. And I think on the demand side, the first 18 days, first 15, 17 days is Pongal in South, and the demand usually recovers after that. So I think it's just been a week after that, and we will know a little bit better, in the coming days. But usually this quarter is a better quarter from a seasonality perspective, and this quarter volumes are likely to be higher than the December quarter. So I think on the pricing side, we think that there is weakness. Maybe it will recover a little bit from here, but it's hard to predict prices quarter on quarter in this industry.
Sure, sir. Thank you. My question was mainly in terms of volumes only. My second question is, sir, on raw material costs, especially slag and fly ash costs. So YOY, how much escalation or increase have you seen especially in slag costs? Because I'm seeing that most of your power and fuel cost benefit is been offset by other raw material costs. So just wanted to understand how much slag cost and fly ash costs have increased on a YOY basis.
In the earning release, you have mentioned the overall total raw material cost. I think the breakup beyond that would not like to share. So the overall 9 months, there's a drop of about 3%, and quarter on quarter, it's almost flattish.
Okay, sir. No issue. And so my last question is regarding the green power mix. So in FY25, I believe you will be adding around 120 megawatt of green power capacity. So can you please give a breakup of how much will be WHRS and how much will be solar and wind? And what will be your green power mix by the end of FY25?
So majority of that will be solar, and we expect, I think, the year end to be close to upwards of 35%.
Thank you so much, sir. I'll get back into queue.
Thank you.
Thank you. Next question is from the line of Satyadeep Jain from Ambit Capital. Please go ahead.
Hi, thank you. First question on market share. Obviously, we've seen some market share erosion in the past few quarters. You're mentioning a strategy to gain market share and taking some initiatives. Can you elaborate on what kind of initiatives or change in course of action you've taken so far or planning? Is it maybe change in some mix, maybe targeting more non-trade also, change in incentive structure? And also tied to that would be the JP acquisition. It's been few quarters of tooling, not meaningful bump up in volumes there. Have there been any surprises on either side now that you've seen this asset? And what is stopping from increase in tooling volumes till we complete the deal? That's the first one on overall volumes.
This is Puneet here. I think, the initiatives that we are taking in terms of expanding our volume is that, one, we are expanding our reach. We are recruiting new dealers. We are also investing time and money in deepening the relationship with our existing dealers and also our institutional customers. So we are also looking at how we can, invest more in demand generation. And, you will see more of this in the coming quarters. As regards JP, I think, as I said, that the plant needs more investments. There has not been any material surprises so far. But I think it's operating at a high cost right now. And that high cost structure prevents us from expanding our reach beyond certain markets. So we are unable, and also it's running at low utilization right now. Because initially in the earlier, few quarters, there was a lot of transition-related issues where the dealers needed confidence to work with the company. And I think now slowly we are, ramping it up. We have also made investments in, it's a new region for us. So we've also made investments in more brand awareness. And all these things take time. So we have inherited a high-cost structure plant as of now, and we don't have full control over the assets. So that's why there is some limitation and constraints under which we are working. And but the good part is that we have spent this 1 year learning a lot about the market, learning a lot more about the plant, and we have a full plan ready so that we can hit the ground running as soon as the acquisition happens and bring it to the Dalmia cost structure.
The acquisition completion is largely the approval from lenders that is taking time.
Yes, absolutely. It's a lender approval process, and I think we are quite confident that we should consummate the deal this quarter.
Okay. Just one more question on the capacity expansion. Obviously, you're reiterating 75 million tons by 27. Is the company fairly ahead in the planning process? Because 27 means you need to start looking at maybe ordering in the next few months. So can we have these sites been identified, and can we expect ordering for this expansion in the next few months? And another one tied to that would be, there is a peer who's talking about expansion in Northeast by setting up a subsidiary. Could that be a risk for competitive intensity in Northeast?
I think, we feel that there will be continuous expansion in this business because just like us, everybody sees the India opportunity. And, I feel that, to remain competitive in this industry, we have to, have a low cost structure on which we've done a lot of work and we'll continue to deepen that journey. And I think, secondly, we have to, invest in market-facing functions like sales, distribution, and also, delivery time and brand. So my personal view is that, in the long term, the entry barriers in this business are rising. And, I feel that there will be periods of high competitive intensity, but, we feel that consolidation is inevitable in this business. And eventually this business will, definitely offer volume growth. And we are modeling a, low pricing growth. But, if consolidation reaches a certain level, there could be upside in terms of prices over the next 7 to 10 years, 5 to 10 years. I don't know how to predict it. But I think we are not taking a, short-term view on this business. We have benefited from taking a long-term view, and we will continue to be consistent in our investment strategy by looking at this business in the long term.
Can we expect equipment ordering in the next 6 months for the next leg of expansion?
Yes, we are doing very detailed planning site by site. So, you will see, very clear announcement with very clear timelines from us.
Along with, in addition, prior JP, we have already announced roughly about 59 odd million tons already, right? So this is incremental 60 million tons is what we're talking about. To a large extent, the planning is done. There's some final details to be done, but to a large extent, planning is done. I think we're just delaying the announcement by a quarter because, this year the volumes have been slightly muted. We're just waiting for a lot of initiatives taken. We're also seeing this quarter how the performance coming. See, once we commit to the thing, then if we are allocating capital and we're committing to spending that capital. So we just wanted to see for one more quarter and also look at the JP acquisition getting consummated this quarter. And then probably be able to be more confident in terms of rolling out the 75 million ton plan. So, it's just a delay of one quarter because we also want to just check a few things before we roll it out.
Okay. Thank you so much, and wish you all the best.
Thank you. A request to all the participants, please stick to 2 questions per participant. Next question is from the line of Ritesh Shah from Investec. Please go ahead.
Yeah, hi. So thanks for the opportunity, sir. I have 3 questions. Sir, first is on the industry side, you indicated price growth of say around 2%, cost inflation of 1.5, and EBITDA in the range of 1,200. Would it be possible for you to give a sense on what is the threshold ROC that you look at the industry level? The reason to ask this is basically we are looking at both attractive volume growth as well as pretty decent profitability. So what is the ROE estimate that we are looking at, or are we calling that the profit pool will shift from mid small cap toward the larger top 4, top 5 names?
Gradually, you can expect that all leading players, they should be able to earn about 15% return on capital employed. But of course, this will be on a mix of the old assets as well as the new assets. And new assets normally take a couple of years before they start earning 15% ROC. But on a blended basis, we can expect that the leading players should be able to return on capital employed of 15%.
I would presume this is post-tax and excluding incentives?
Incentives are included, but yes, it will be post-tax.
Okay, this is helpful. Sir, my second question is on, I think the next phase of expansion. I was just looking at the limestone auction. I think company has done phenomenally well to augment reserves upwards of 1.3 billion. However, if you look at the average premium, also it's upwards of 50%. So for the next phase of expansion, how should we look at the incremental capex intensity, which I presume would be largely greenfield, and the cost curve for the next phase of expansion versus the current assets? Are we looking at a steeper increase, so more of OpEx inflation as well as on a capex side?
On the capex side, I think you can expect average cost of the capacity is close to about $70 to $80 per ton basis. It will be better because there will be a couple of brownfield opportunities also and greenfield also. And if any acquisition happens, it could be in the range of $80 to $100 per ton. And of course, on the OpEx side, fuel remains uncontrolled element, but as more and more coal mines are being auctioned, industry will have more control of their key cost structures.
Also, I was referring to limestone.
Limestone auctions, of course, it will be through auctions only, and marginal increases you can expect going forward.
Okay, thank you. And just a last question, sir. How do we see slag inflation? And Dalmia has been up on the curve when it comes to ESG. So are we looking at a launch of calcined clay LC3 anytime soon? I think most of the mills have indicated that they are already ready with it. So is this also something which is there when you say within 3 years, 100% blended cement?
Yeah, 100% blended cement is one of the stated objectives, and of course the specific details of product elements that of course we will not be able to share right now.
Thank you. Request to all the participants, please restrict to one question per participant. The next question is from the line of Pratik from Jefferies India. Please go ahead.
Yeah, good morning, sir. My question is on JPA volume. So when you say 15% volume growth, so you are expecting how much for the JPA volumes in FY25? And do we expect the cash outflow related to JPA in FY24 or FY25?
So we do not share the region-specific volume separately. And as we said that it is expected in the next couple of months, we are targeting that it is closed within March. So if it happens within March, our cash outflow will also happen in March, but it could be 1 month here or there.
So Pratik, Rajiv here. I think on JPA volumes, why we have been sharing the JPA volumes in this quarter is because we started tolling from Q4 of last year. And it is only right to share the JPA volumes separately so that you get a sense of how we are doing in our, core markets. But having said that, I think once we already completed 4 quarters of sharing JPA volumes, there is no reason because nobody gives numbers separately in terms of, how much you're doing by each asset. So I think, JPA will become part of our core assets, right? And then giving those segmentation will become difficult. I think when we're targeting a mid-teens growth, we are factoring in all the assets that we have, including JPA, which will become an integral part of our, asset base. And on the next question? On the cash flow part, I think we are hoping to close this by March end, right? But, by the time it gets closed and then diligence has to be done. To a large extent, the cash outflow will only hit probably a month and a half after the consummation to a large extent, after the final.
Sure, I'll get back to the queue. Thank you.
Thank you. The next question is from the line of Pratik Maheshwari from HSBC. Please go ahead.
Hi, sir. Thank you so much for the opportunity. Sir, my question was on the JPA. So, sir, when you are, as the deal is close to completion, I wanted to understand, sir, would at 9 million tons of grinding, would you guys face problems and completely utilizing the asset because probably so far the clinker is available at just 4 million tons? And also looking at from the perspective that the markets that you're entering are probably more PPC oriented. So obviously the clinker to cement ratio will come down. That's my first question. Another question is just wanted to kind of just squeeze in. What could be the expansion opportunity on the clinker side at the JP plants?
So when we acquire, let's say 9.4 million, definitely some clinker will be short. But of course, the ramp up of these plants may take time. So till that time, we'll have whatever required clinker is there, that will be available with us. And there'll be opportunities for expansion both for the clinker as well as the cement capacity in the central region within the same assets.
Within the same, okay. Thank you.
Thank you. Next question is from the line of Navin Sahadev from ICICI Securities. Please go ahead.
Thank you for the opportunity. Just one question on the renewable power front. So in the 9 months, there has been a very small, just about 9 or 10, 11 megawatts sort of an addition in the solar power front, whereas bulk of it is then obviously left to Q4. So my question is there a reason why the progress is slow? And in the same breath then, the target next year, which you answered in the previous question, that bulk of the addition for the target in to FY20 of 328 megawatt of total renewable power, bulk of it will be solar. So will that also be back-ended? Thank you.
See, the technology on the RE front has been evolving, and of late, let's say in recent months, when solar panel prices have reduced significantly, which translates to a lower cost of RE power. So had we contracted these power contracts, let's say 6 months before, we would have lost the opportunity of contracting much lower rates, which we are able to do now currently. So you can expect that, of course, bulk of this may come, let's say, around the mid of the year or maybe just third quarter of the coming year. But subsequent announcements now will be much faster.
Thank you.
Thank you. Ladies and gentlemen, due to paucity of time, we'll take that as the last question. I will now hand the conference over to Mr. Punit Dalmia for closing comments.
Thank you very much. I appreciate all of you taking interest in us and sharing feedback with us on this call and off the call. This is our first call in 2024, so I take this opportunity to wish you and your families a very happy and prosperous 2024, and look forward to connecting with you again in the next conference call. Thank you.
Thank you very much. On behalf of Dalmia Bharat Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.